Hey traders, and welcome back to another video. So, in this video we would reveal the best methods which would help you in identifying and plotting the support and resistance zones on the chart. And after that, we would reveal the easy and effective support and resistance zone strategy. So make sure to stick around the end of the video. We would be covering all these topics in this video. First, to begin with, let us understand what are support and resistance levels. The support zone is a price level that can prevent a downturn due to a concentration of demand or purchasing interest. The support zone includes a substantial number of purchase orders. During the uptrend phase, the support zone is highly useful as it helps the traders to buy at the lower price and sell at a higher price. And likewise, the resistance zone is a level that prevents an upswing due to presence of significant amount of sellers. The resistance zone is much useful during the bearish trend. Due to this, the traders can achieve their aim of selling at a higher price and buying it at a lower price, which in turn makes them profit. If you're finding value in this video, give it a thumbs up. Now let us see the next topic, which is the types of support and resistance zones. The first type is none other than the traditional swing highs and swing lows. These levels can be easily identified on both lower and higher time frame. Now here is where the problem arises. Support and resistance zones are often plotted by the traders at one time frame only. But it's not a problem if they plot them at a longer time frame. But if it is being plotted at the lower time frame, then the trader may end up having significant losses. It is because the market usually respects the key levels of higher time frame more than that of the lower time frame. And hence, we advise you to use the multi-time frame analysis. In this type, when the market makes a double top or double bottom, we would draw the zone from that point. Like in this case, the market is seen making the double top pattern. The daily bias is bearish. Now looking at the left, we can see market has tested this zone multiple times. Now as this zone has been tested multiple times in the past, we would call this zone as a key level. After plotting this zone, let us wait for the market to come to this zone. After this happens, we will move to the lower time frame for confirmation and entry. Since the market has reached this zone, we will switch to the lower time frame. So at the lower time frame, we can see market creating bearish candles of big body. And hence, we would go short from here. The market continued going downside and has reached at our target point. This is the simple, or you can say traditional, way of plotting the support and resistance zones. The tools like trend lines and moving averages also provides a dynamic support or resistance to the price. During the bullish phase, the trend line is drawn below the price as it provides support to the price. Let us see it on the chart. So, here we have the Euro-USD pair. The market is in the bullish phase currently. And since the market is in an uptrend, we would draw the trend lines below the price. And after doing so, we would check if the market is respecting this trend line or not. The market is respecting this trend line as it is making an impulsive move once it reaches at this trend line. The market has done this thing for 3 times. And hence, we can conclude that this trend line is providing a dynamic support to the price. Just like the trend lines, the moving averages also provides a dynamic support to the price. The moving average is the average of the specific candles and is represented in the form of line. The moving averages that are highly respected by the market and thus are used by a lot of traders are 21, 50, 100, and 200 period moving averages. The day traders mostly use the 21-day moving average. The short-term traders uses the 50-day moving average line. The medium-term investors uses the 100-day moving average. And similarly, the long-term investors uses the 200-day moving average. Let us see an example of it on the chart of the market. So, here we have the Euro-Pound pair on the 1-hour time frame. The market is making significant higher highs and higher lows, which suggests that a bullish phase is going on. This is the 21-period EMA line, and below it is the 50-period EMA line. So, the market made the pullback multiple times. And most of the times, it respected this 21-period line. And so, we can conclude that the 21-period EMA is providing a dynamic support to the price. And sometimes, the market made the big pullbacks which pushed the price below the 21-period line. In that case, the market respected this 50-period EMA line. Same thing happens during the bearish phase of the market. During the bearish phase, these moving averages would provide dynamic resistance to the price. A lot of individual traders randomly draws the support and resistance zones on the chart and then they blindly follow these zones. Like in this case, the market is making an upward movement when it reaches at this zone. By seeing this, a lot of individual traders would plot the support zone here and also would place their buy limit order at this point. But what did the market do? It went below this so-called support zone, and after going below it, it started going upside. This move by the market removed the early buyers. For knowing the reason behind this movement of the market, we need to move on to the higher time frame. On the higher time frame, we can clearly see that the market is making higher highs and higher lows. And then, the market started to get weak due to lower number of buyers or more selling pressure. This little pullback into the higher time frame seemed like a downtrend into the lower time frame. Using the multi-time frame analysis to discover the trading opportunities and the flow of the market is extensively utilized and extremely successful. Let us see how can we discover the trading opportunities by using the multi-time frame analysis. So, here we have the Euro-Pound chart on 4-hour time frame. The market is making higher highs and higher lows. Let's analyze this chart on this higher time frame and plot the key levels. A resistance level has been created, and after that the market has made a breakout. Now as the market has made the breakout on the higher time frame, there is an assurance of market going above in the future. And thus, we would go on to the lower time frame for taking entry. The SL would remain below the resistance zone and the target would be 3 times the stop loss. One of the best thing about the support and resistance levels is that it can be used multiple times, unlike the order blocks. Now that we have learned about the support and resistance zones, let us move to the strategy. This strategy would help you in buying the currency pair at the lower price and selling it at the higher price. Before we begin with the strategy, let me tell you that this strategy only works during the trending phase. So, avoid using it during the ranging phase. Let us learn this strategy through an example so to give you a better understanding. Here we have the Euro-New Zealand dollar pair on hourly time frame. The market is making a series of impulsive moves and corrective moves. And currently, the market has made an impulsive move. Now as we are in an uptrend, we would find the areas from which we could go long. The aim of every trader while going long is to buy at a lower price and sell at the higher price. So, we would wait for the market to make a correction move in order to go long. The price has started to weaken and hence, the correction move has started. Now let us analyze and draw the key levels on the chart. There are 2 key levels in this chart. The first is this resistance zone, which may turn into a flip zone. And the second is this order block zone. In this correction move, we can see that the market has made doji candles, which signals that the sellers are getting weaker. As the market has made the doji candles on this flip zone, there are higher chances of market going above from this. But there's no assurance of it. For getting it, we will have to wait for the market to give out a bullish confirmation. Now we would move to the lower time frame to see the bullish confirmation of the market, and once we get it, we would place the buy order into the market. At the lower time frame, the market has started making bullish candles. This big candle gave us the confirmation that we needed. Now that we have got the bullish confirmation by the market, we would go long into the market from this candle. The stop loss would remain below this key level. And the target of the trade would be 3 times than that of stop loss. The market went above, which helped us in earning significant profits from the market. Now before we end this video, if you liked watching it, be sure to hit the like button and don't forget to subscribe the channel.